Hello and welcome back to video series for Forex beginners. If you are new to Forex and you want to learn Forex, this is a video for you. In fact, it's a playlist. We have for the advanced and then for the intermediate. So in the video description, you see that, and then you can do accordingly. So on this playlist, we have done a number of them, and then I think this is episode 12. And episode 12 will be some terminologies on, in fact, in Forex. If you want to trade Forex, there are some terms that you need to understand them. I think for this particular episode, we have already done part one, even though it is not in that sequential form, part one. And that was on episode 5, right? So so if you are new and then this is the first time of watching the playlist, I would suggest that you watch from the beginning of the playlist so that you have a fair idea of whatever we are doing here. So without further ado, I think we have to just bring in and then deal with this. We don't want to waste my time here. So that is it. So this point will be for but first of all, before I even tackle on the terms, we still have to keep reminding of the disclaimer part of this playlist or this profession, I should say, right? And especially on the risk management. So I think we have already done that, but I just want to keep reminding you of that. It is an important aspect of of this profession, so you have to just keep in mind. So I just wrote something briefly, and it says that it is important to note that trading in the financial markets carries a high level of risk, right, and may not be suitable for all investors. It's crucial to thoroughly research and understand these markets before making any trades, and to never invest in more than what you can afford to lose, right? Traditionally, it is important to use sound risk management techniques and to regularly monitor your trades to ensure that positions remain within your risk tolerance. Why am I saying this? Or why did I even have to bring up this in again? Because where we are getting to is the interesting part of this profession. There are terms that if you don't understand them, you can't actually trade well, right? And then you meet your colleagues talking about these terms and you find yourself wanting. So many a time, in fact, it is important that you get yourself abreast with these terms, right? You have a fair understanding of this and how they are used or what they mean. So that is, I think the first term will be what? On leverage. So what I'm going to do here, there are some writings that I've done. I've written a lot of some notes, quite, yes, under these terms. But I prefer that when you listen to me first before reading, I think it's a good idea. It makes you understand whatever I'm going to say in a nutshell. So leverage. So in the business term or yes, or in the financial term, when you say leverage is just some opportunity, right? Some capital or some kind of effort, right? Giving you, right? To give you the ability to what actually get enough money to do something when in actual sense you do not have that required money to actually trade, right? You are supposed to buy something, you are supposed to do something, but you don't have the full money, like the full capital to actually do whatever you have to do, right? So they have to give you some kind of a force, some kind of opportunity, some kind of I don't want to throw you the term leverage, but that is give you some leverage to actually do that. So in this forex, what is actually meant is that before you can trade a particular pair or an instrument, you need some kind of what capital, some kind of money to actually what either buy that currency or get that instrument or sell that currency. Right? You need some currency, some amount. But many a time, as a retailer, retailer, you may not have this kind of money in your account, in your capital. So what you do is your broker, and this thing is actually provided by your broker. So they give you some kind of money, which we can say in the layman term, like a loan, right? They borrow you some money, that kind of money to actually what do that transaction. So after that transaction, you just have to what release that money to them. So this is as simple as that. From the layman perspective, from the basic level, that is what we mean. So you don't have that money to actually trade. So your broker will have to give you that money, that kind of a loan to actually do that. So after that, you just have to pay them back. So the system will actually release that kind of money to them. So this money is their money. Like I said, that in Forex actually was actually not meant for individual traders like the retailer, you and I, right? It's meant for institutions, big institutions, financial institutions, the hedge funds and all that, right? So as an individual, you may not, in fact, you do not have that kind of money to actually trade, right? So it's the broker that actually gives us that the gateway, the avenue to actually do that. So this is one of the things that they actually do to give us what the opportunity to actually trade with the big institutions. So that is what it means. So in a nutshell, we are just going to read that. I may not even take each sentence to explain them, but that is what it means. So that is it. So leverage is the ability to use something small to control something big. In the case of Forex, it is what? Using a smaller capital base to control larger lot size. Leverage is a ratio of the amount of capital used in what? In the transaction. What? Transaction to be required to what? To require or to acquire security deposit, right? It is the ability to control large dollar amounts of security with a relatively small amount of capital, right? Leveraging varies dramatically with different buckets, ranging from 1 to 2 to 400 is to 1, right? So that is it. So whatever money you need to do that transaction for a pair, every pair, right, has some amount of money to actually transact in them, right? But here is the case, your money that you need to transact is small. So these people give you a leverage, and leverage is usually given the ratio, right? So that is what it means. So whatever ratio they give you, you just have to multiply that your money, right, with it. Then you actually what meet the target. So that is what is given. So this is you do practical things and then you understand it. But for your level, just take it as it is, right? So in forex trading, a small margin deposit can control a larger total contract value, right? Leverage gives the trader the ability to make nice profits. At the same time, keep risk capital to a minimum. For example, forex brokers offer 200 one as is to one what leverage, right? Which means that a $50 margin deposit would enable a trader to buy or sell at 10,000 right dollars worth of currency, right? So your money may be as small as whatever, right? So whenever they give you this, you just have to multiply to that, and then you get whatever it is what required. So that is what it means, right? So for instance, 200 by 50 will actually give you 10,000. You understand? So that is it. So this is the money that you have, $50 in your account, and then they are give you a little bit of what? 200. You just multiply that, then you have your what? The 10,000. So that's it. So now, similarly, with $500, one could trade $100,000 and so on, right? So you can understand the first time, you just have to give them a solution and then you are done. But leverage is what? It's a double-edged sword, right? Double-edged sword. Without proper risk management, this high degree of leverage can lead to what? Large losses as well as gains. So that is it. So it means that the higher the leverage, the more profitable it is. In the same way, or at the same time, the more risky it is, right? So if you are in a transaction, which so let's say whatever transaction that you embark on or you engage in, if it's profitable, then you are going to what? Win big. In the same way, if the trade doesn't go as you anticipated, it's the same thing, the same impact you are going to feel negatively. So this is as simple as that. Now, to understand this concept of leverage, let's take a brief history of how Forex was initially, right? So initially in Forex, it is not anymore, it's not anyone that is allowed to trade Forex, right? Just as we see currently in New York Stock Exchange, right? So that is it, right? It was made for the banks, the rich men, the monarchs, the big businessmen and company owners. I've already said this. Now let me take New York Stock Exchange for example. So for example now, for you to trade in the floor of New York Stock Exchange, you should be making a specific amount of millions of dollars per year, right? So these are the requirements. You shouldn't be owing any mortgage, right? Your tax documents are up to date with so many conditions just to limit it to the end, right? There are many conditions besides the money and all that. You have to have your documentation correct, proper and all that, right? So as an individual, that was a difficult thing. Even besides the money that you even need in your account. So you see the thing. Now, this led to the proliferation of Forex brokers, right? Forex brokers had so many customers around the world that they could solve that single problem of capital for us, right? Now, those World Bank, for example, etc., requires a certain amount of money for someone to be able to trade, right? But some brokers have pulled many amounts of money together and now we are allowed to trade actually through these people. So going as an individual, you could not. In fact, your money is not enough. Your documentation and other requirements may be difficult. So these institutions were in position for us to actually trade with them. I think we have all look at this. I think if I don't take this, the video will be lengthy. These all these things, right? So now I think in the nutshell, you know what a leverage is. So you actually appreciate them when you have a real account, right? Some demo actually yes, actually what put this into practice. Demo account, yes. But you actually appreciate them when you open a real account, right? So that is what it is. To leverage, that is it. You will not have enough money to actually buy or sell a particular instrument, right? Or a pair, right? Your money is more. So the brokers, in fact, loan you some kind of money to actually engage in that transaction. When you are done with that transaction, or the moment that position is closed, that leverage is released back to the what? The broker. It's as simple as this, right? And yeah, and the leverage are noted, right, in the form of a ratio. So that is what it is. I think you are okay with that. Now, let's go to margin. Now, whatever we are going to read now, I'll give you a summary. So just follow with the reading, and then at the end of this video, I'll give you the summary. I think with a summary, you have a better understanding of what they are, right? In fact, many mentors do not actually waste their time on this terms, the margin, the leverage, free margin, level, and margin level, and those things. They don't actually have waste time on these things because they know when you start actually trading, maybe you over time you actually understand it. Because sometimes explaining them is difficult to actually grasp when you are a newbie, in fact a novice. So just stick with me, and I will try my best to let you understand whatever it is, right? So now let's move towards margin. Now the margin is the amount of equity contributed by a customer as a percentage of the current market value of securities held in what? Margin account. Don't worry. Now, margin represents the amount of money that you need. The amount of money. It requires the amount what? The amount of money you need in order to trade, right? To enter a trade, right? So it has something to do like let's say like we explained the leverage, right? Your actual money that you have is not enough to actually embark on a trade, right? So your money that you have that is not enough to actually embark in a position. That's what I can say that it's what just imagine, right? So it isn't the amount of money that you need in order to enter a trade, right? So when the leverage is added, then you meet up to that margin. So it means that without the leverage, you can't embark on the trade, right? So with your money, which is not up to, and then with the help of the leverage, then that can give you a margin, right? So that is it. Now, usually it is if something costs $10,000, you need to pay 10,000 for it. This is logic, right? The price of an item, that is what you need to buy. It's as simple as that. Now, that is common, that's a common sense. That's right. However, when trading the forex market, you don't need to have the entire amount to pay for what you are buying. You only have to deposit the amount to cover any possible losses, right? So if okay, let's continue. This deposit is called what? Margin. Now, margin is a deposit required to open, right? Is a deposit required to open and to maintain open positions in the forex currency market, right? A margin doesn't represent a fee or transaction cost. It is merely a portion of your account, a portion of your account balance set aside and allocated as a deposit to initiate a particular trade, right? So that particular trade, the currency that you need to buy, there's some account that the amount, the cost to that, the cost for that. So that cost is what we are talking about. So if your mind does not meet up, then the leverage will come in. So before the leverage comes in, is what your margin, right? Now, the margin is multiplied by the leverage. Like I said, it's multiplied by the leverage to determine the lot size. We talk about lot size briefly. Don't worry. In the next video to come. Now, the margin is a real money amount from your trading capital. For example, you want to trade one micro lot or 0.1 lots, which is equivalent to $1,000. And your forex broker is offering you 50 is what? One leverage. To control one macro lot, you need approximately $20 of your margin from your account, right? The margin will be released back to you regardless if you win or lose your trade, right? So that is it. The summary of this will actually throw more light on this. I don't want to waste time. I want to keep the video within some minutes. Thank you. Now, free margin. Now, free margin is the difference of your account equity and the open positions margin, right? So free margin is like your equity minus margin, right? I will talk. I think the next item is equity. So maybe I should have even treated what equity is, right? So that at least you can get the idea. So let me just briefly do that. Now, before you actually trade in a real account, you have to make a deposit, right? You have to have a trading capital that's for a balance, right? So the moment you do that deposit into your account, real money, in fact dollars or whatever currency that you want, when the moment you deposit that money, the trading capital or your capital into that account, that money becomes what is called balance, right? It's your balance. The balance is the money or your trading capital without any open position, right? So that is the money that you need. So you call that one your capital, or better say your balance. Now, when you enter a position, right, then there's another portion called what? Equity, right? So the equity is normally equal to what? Your balance when there's no any position open, right? So that is it. Now, by your equity at times, when a position is open, right, the moment you enter a trade, your equity can be equal or less, or even more than what? Your balance. Please don't be confused, right? If you deposit money into your account, or if there's no any open positions as in insertion at the moment, your balance is equal to your equity. The moment you enter into a trade, right, your equity may be what? Equal, less, or even more than your balance. Why are we saying this, right? So the equity comes in when there's a profit or there is a loss, right? In the open position. So if you enter a position and then at the moment you are in profit of let's say $2, right? Your balance was like $1,000, right? And you enter a position and you are in profit of $2. Now your equity is what? $1,002. I hope you are getting the picture. Your equity is what? 1,002 because you are in profit of what? $2. Now, a situation whereby you are in a loss of same amount, like let's say $2. Now your equity is what? Less than your balance because you are in loss. So these $2 will be taken from your balance. And now your equity is what? 900 what? Let me see. 998, right? Yeah, 998. The equity will be 998. So that is it. I hope you are getting the picture. So back to this case, back to the free margin. Now your free margin is what? Your equity minus what? Your margin. Bear in mind, when you open an account, right? You deposit, and there's no open positions. Your free margin is equal to your margin, right? It's equal to your balance, and it's even equal to your equity. We have another term called what? Margin level. So all these things are equal when there's no open position. So I think you are clear with that. Now, at the end of the video, I will open one of my accounts with open positions and then one without open position. And you appreciate whatever is going on. So I think you are getting the picture. So back to here, we are here, right? Now, so when you have no position, no money from your account is used as a margin. You understand? When you have no position, no money from your account is used as a margin. Therefore, all the money you have in your account is free. As long as you have no position, your account equity and free margin are the same as your account balance. Thank you. I think, yes, I didn't even read it, but I just spoke about it. And here we are. Now, and for example, when you have some open positions in the 1,100 in profit in total, then your account equity is your account balance plus this 1,000 whatever. I was using on $2, and then here we are using 1,000 happiness. It's as simple as that. Any amount that you could do in profit. Now, if your positions were 1,500 in loss, then your account equity would be your account balance minus that. Is as simple as that. So I think we have had a brief discussion about equity. So just let us just read through it. Now, the account equity or simply equity represents the current value of the trading account, right? So what it means that if you want to actually know your balance, whatever money is left in your account or at your disposal is what? Is your equity. Your equity talks about your current balance, your current money that you can actually have, provided or if in case you want to close all your trades running, right? So that is the equity. So you just have to know these things and know how you have to manage what the risk. That is why I introduced you to what that brief risk management disclaimer side of it. Now, equity is the current value of the account and it fluctuates with every tick when looking at your trading platform on the screen, right? It is the sum of your account balance and all floating. Floating is unrealized, the negative and the negative values and the positive values. That is what we are talking about, floating, right? Associated with your open positions. Equity is the sum of balance and current profit or loss of open positions. Or once you enter trade, right? Your balance plus your profit or loss in the running trade. I think I've done this. I've spoken about this. That's when you are in a trade and you are what? You are in a trade and you are in profit. The equity will be increasing. In the reverse, when you are you are running a trade or position and you are losing your equity, and you are losing your equity is what? Decreasing. That's simple as that. It's logic. You don't need any special intelligence for this. Equity is your account balance plus the floating profit. Or yes, I think we are doing this more. Yeah, so now equity in the form of like an equation form is equity, right, equals your balance, right? Your balance plus the floating profit or the loss, right? That is it. So if it's a loss, it just minus the value, right? Right, you know your body mass. That is it. So now, so when you have no open position and so no floating profit or loss, then your account equity and balance are the same. Thank God. I've, I've said this already. So now let's look at the summary. Right, the summary, I think this is what I should have even focused on, just to make the video very brief. But I just wanted to introduce you because for an amateur or novice, you actually have to understand the things from the onset, right? From the basic level, right? So that it doesn't look like you are just jumping from nowhere and then you are just talking about the thing. So that's why I have to take you through that. So don't worry if you are having difficulty in understanding, or maybe I don't know how to actually explain in depth. Just catch it from here, right? So let's look at margin again. Now, margin is the amount of funds withheld by a broker to keep an open order, and it's calculated in the trade is what? It's calculated in the trading account what? Currency, right? Whatever currency that you deposited, you could actually deposit in pounds, pound sterling, in euro, in the dollar, the popular one, even sometimes in your local currency. Some of the brokers actually allow this. Xness allows that. It's very good. I have an account with them. In fact, in cities, you understand. So margin again is the amount of funds, right, withheld by a broker to keep an order open. So without this amount, you can't have an open position not running. Else, then you have a problem called a margin call, right? We look at that briefly. So that's the amount of money that is needed in your account for that side of it to keep your trades actually running. So that is it. Now, leverage is the ratio of equity to loan capital. I told you that it's like the loan money that's given to you by your broker to actually what engage in the transaction. Without that money, your margin, right, or your balance or your capital will not be able to what do that transaction. You're not able to what supply that transaction. So that is it. Now, an impact in the margin held when an order is what open, right? So leverage actually go hand in hand with margin. So far, if you are very attentive to whatever I am saying now, you realize that margin and leverage they actually go hand in hand. You understand? So the higher the leverage, right, the lesser the margin required. You understand? So that is now. Balance, equity, and free margin. Let's look at it. Now, balance is the calculated total of all completed transactions on your what? On your trading account, including deposit and withdrawal, right? Now, withdrawals is when you have actually engaged in trading positions and all that, and you have come to what realize some profit, right? You can what cash out, you can withdraw. Better so you can actually deposit some amount of money, right? Then maybe let's say for instance you deposited $1,000, right? And then you engage in some transaction and you lost about 500. So now you are left with what $500. Yet, bear in mind you can actually withdraw this $500. It is your money, it is your capital. So whatever you like, you can do that transaction with that. So that is it. Now it can be the amount what of funds you have before opening orders, right? The balance that you're talking about. Or after you have closed all positions. So when you have not lost all your money. So the balance does not change while others are what open. Bear in mind, the balance does not change, but the equity changes. It fluctuates. So that is it. The balance will only change after you close an order. In fact, you close all your positions. In yes, an order or your position. So that is it. Bear in mind. You don't worry, you appreciate this when you get to the practical. Now let's move what? The equity. Equity is the balance of trading account plus or minus total real profit or loss of swap charges. Right? You have to look at this. The equity can be less, can be equal, or can be more than the what? the balance. It depends on whatever transaction that is going on. Is it profitable or is it loss? So that's where you what ascertain, you can determine this. Now there's one term called swap, right? I won't go deep, but a swap is what the fee that is charged on opening positions for what running overnight, right? And this charged with what the brokers. The brokers actually do this, right? So if you open a position normally under normal circumstances, an open position is supposed to last within what 24 hours. So if you open a position and it lasts more than 24 hours, then the broker will charge you a fee for that, right? They are keeping your open positions running. So it's like what operation fee, right? Every company will have to have some operation fee and then some charges to keep their company running. So that is, but if you don't want that, then you should be a day trader. You open your position and then you close within the 24 hours, right? We have looked at the type of traders. So you see the what? The advantage and disadvantage associated with all this kind of what trading what type of traders, right? So that is it. So in the equation form, we have the equity, the balance plus or minus floating profits or loss, better still plus the swap, right? So now there's another attention. Swap can be negative or can be positive. I don't want to go too deep onto that in that, but it just for your level, just assume that a swap is what? It's a fee that you need to pay to the broker. It can actually be a fee paid to you by the broker, whatever. So just let's keep it in there as a negative value, right? So I think that's important. Now, while the broker holds margin for open orders, right? For open orders, the fee margin is the funds remaining. Fee margin is the funds remaining in what? In the trading account that is not held, right? In other words, it is found free to use for new orders. So, like we said, for every instrument, a transaction or procedure you need to enter, you need some amount of money. So there's some portion of your balance taken to be the margin, right? Some portion of what your balance taken to be the margin for you to actually what engage in what in a particular transaction. And then with the help of a leverage, you can actually what do that transaction. So that is it. Now, with this margin taken from the capital or your balance, the rest of that money is what is sitting there. So that money is what we call free margin. So the free margin is that money could actually be used again to engage in another transaction. So that's why hence the term free. So you can actually go and take that portion of the money and then enter into another trade. That is why, for instance, one trader can actually open or have many positions, right? So they're able to have this free open positions because of the help of what? The free margin. So without the free margin, you can't enter another or extra trades, right? I think I've come down to your level. So that is it. So and then we go to margin level, right? So we have done equity, balance, margin, and free margin. Then there's a last term called what? Margin level. So the margin level is just expressed in the form of percentage, right? That's margin level. So the margin level is a ratio, right? It's a ratio of equity to margin denoted in percentage, right? It's a ratio, right? So a ratio of equity to margin denoted in what? Represented. What? Yeah, represented in what? In percentage. So that is the equation. Free margin level. Sorry, margin level is equal to equity over margin, right? Equity divided by margin times the whole thing. The whole thing times what? Your 100. This is a board mass. Don't be careful. You don't have problem with the board mass, right? So you can actually do that calculation first before you multiply by 100, right? The 100 is not multiplied by what the margin. So it's actually multiplied by the whole of that ratio, right? So the whole of that fraction. So that is very much. So imagine now. So that is as simple as that. I mean, there's no need to go into deep into that. Now, a margin call. I said something like a margin call, right? A margin call is an alert sent in the trading terminal warning. The trading terminal is just the MT4, MT5. That is it. Trading terminal is MT4, MT5, right? Other brokers can have a portion of them and then rename it, whatever, but it's the trading platform. That is it. Warning, that is right. It's an alert sent in the trading terminal warning that it may be necessary to deposit funds or close a few orders to avoid stop-outs. This notification is sent once the margin level drops to certain amount, known as the margin call level, right? So the margin call level is set by an account type, right? Every broker has different types of account types based on the leverages that they actually provide, right? Some benefits attached to it. Yes. So the margin call is just a notification to tell you that your margin is actually is dropping, or the transaction that you are engaging in, your money is getting what finished or something of that sort, right? So it's either you close some few trades, or you should what deposit more money so that your margin can actually be what increase and then continue to engage in that transaction. So that is what it means. The margin call is a warning sent to you. Now, we also have this stop out. So the stop out is the automatic closing of orders. When the margin call, sorry, when the margin level drops to the stop out level in the percentage, right? So now they gave you a warning, you were given a warning. If you don't act accordingly, then just the opposite, the worst will happen. So that is that. It's as simple as that. So thank you very, very much for watching. I think um I think you understood this. For an amateur, it may be difficult. In fact, for myself, when I started, I had difficulty in understanding this, right? But I think I've tried my best to let you understand it, right? If you think you're still having difficulty, you can look at some sites and then have a fair understanding of this, more understanding. In fact, you can watch other videos until you think you are okay. Right. So thank you very much for watching. See you in the next episode. Please like and share. And then if you have any problem, you can reach us, and then we will see the way forward. Thank you very much. See you in the next episode. Bye.